I'm in Washington, D.C. for the Real Estate Roundtable's fall meeting. Joining me today is David Twardock, the president of Prudential Mortgage Capital Company. David, we're starting to hear a lot about the looming debt maturities and the issues that that's going to cause. How severe is that issue, and where do listed REITs fall?
Well, there's been a lot of discussion about the debt maturities now for a while. There's about, depending on how you add it up, about $300 billion a year in maturities. About half of those, a little bit over half, are on the balance sheets of banks. The rest are spread out fairly evenly across insurance companies, GSEs, and the CMBS market. A lot of those loans are properties that are overleveraged because of the Great Recession. And I think the key is the capital for deleveraging the assets. I think if the equity capital is there, then say between $30 billion a year of insurance company loans, 30 to 35 billion of agency loans, hopefully a CMBS market that hangs in there and can do 30 billion a year, and maybe 100 billion a year of bank debt. If you can bring in the equity capital to delever, to make up the gap, then I think there's enough capital to handle it. But it's very much confidence-based. And the listed REITs are important because they're a key component in bringing that equity to the table.
Now, when you mentioned CMBS, you sounded a little on the uncertain side. What is your take on CMBS? How viable is that market?
Well, it's certainly, it felt really good 3 or 4 months ago. Felt like the market was back, a lot of confidence, a lot of bond buyers. And it's certainly, since the summer, there's been some upheaval in the CMBS market. I think we're at a place where it's the confidence part of it. There's less, the CMBS market, there's less certainty about, and it's a higher cost of capital than for the other suppliers of debt capital. And it really is a matter of, are the bond buyers going to be confident about the returns that they're going to get? And particularly in the middle of the stack, below the AAA bonds and above and ahead of the B-piece buyers, there's some fairly significant issues in that space in getting those bonds placed right now.
And the last time we spoke, you discussed some of the options for supplementing the GSEs in the multifamily market. Do you still think that there's room and the ability for the private market to step in and close that gap?
Well, I think there's demand for multifamily loans in the private space. But as I think I said, there's a sector of the multifamily market where it's true affordable, and maybe it's in secondary markets and tertiary markets where there's a gap there that either the FHA has to fill or the CMBS market has to fill. If not, you need the GSEs in there. So I think there's a space there that has to be filled by the GSEs, and ideally they'd be able to expand and contract as the private market expands and contracts, and make sure there's capital available for those properties. If there's not capital, then the properties decline. You end up with deterioration in living quality, and we don't want to see that.
And lastly, what are your expectations for GSE reform?
Somewhere down the road. I don't think anything's going to happen in the near term, certainly not before the election.
Great. David, thank you very much for joining us.
Glad to be here.
For more on this and other REIT news and analysis, be sure to visit REIT.com.